but I bought the buy side of the sell side model. In other words, this original consolidation in here, all this consolidation, we see it take the sell side here and then it rallies through. Does the market come back to its original consolidation? No, because it would have done it here. It didn't do it. So is that strong or weak if we're expecting prices to be drawn up into this daily volume imbalance? It's extremely strong. So my mind immediately adopts this. Okay, as we enter this area here between these two levels, that balanced price range, if it's really going to have the influence on price that I think it should, which is don't touch the lower end down here. That midpoint level's right here. You can see how we went through it. Does the body disregard that midpoint? No. Can it cross over that? Yes. What do we call that? Mohawk. You have to allow it to be there. So while we have very specific levels, the bodies of the candles are telling you the narrative. Yes, it does go down below midpoint of that. So when we are anticipating specific levels to be traded to, we're not expecting and demanding that it stops on a dime right then and there. Now, can it do it? Yes. And when it does, it's a fascinating study, but it's not important. This level here, 14,422 even. See the zeros? So 22 even, and the low on this candle comes in at 19.75. So it's less than 2.5 handles. Now, if you're going to lose your mind over 2.5 handles, but you expect it to be respecting that level, you have to have a stop loss that's going to at least allow for that mohawking, that little push beyond the level of where we expect the real turning point. Is it happening and justified and confirmed with the bodies of the candles here, here, and here? Absolutely. I want to see, does it keep supporting that? And it does. Then it rallies through. Now, this range here, and again, I'm just eyeballing it, the idea of these quadrants, this is where I believe that price was going to draw to from down in here. Okay, so if this level from here all the way up, best case scenario, terminus would be the high end up here. So that range is what I think that price will traverse from here to here. If I'm right, if I'm accurate, and if I'm dialed in on what I believe the algorithm is going to do, it's going to reprice to the high of that. So when I'm drawing out on these charts, like this fair value gap in here, in my mind, what I was interpreting was, does price want to react off of that? And if it does, I want to see how fast it can reach to the lower quadrant, which is this level here. So if we measured from the low of this blue shaded area all the way up to the top and divide that in half, that's this level here. That's consequent encroachment because it's an inefficiency on the daily chart. The lower quadrant, I want to see how fast we reach up into that. Whenever I have an inefficiency, whenever there's an imbalance at any degree of a draw or it's ahead of a target that I'm reaching for, let's say that I was wanting to see 14,500, which would have been outside the scope of the price range that's being shown here. Okay, like say I believe that what I wanted to see happen this morning. And then we also have this daily volume imbalance. I would not be so inclined to take all my profits off in here. I would take about half and then 80% would be up here and then see if I can reach that target. But because this is my target, I want to see it trade up into this area here. I want to see how fast we trade up into that lower quadrant. Does it do so real quick? Well, look what it's doing here. It's hitting the low end of it here and consolidating. Now, as soon as it does that, I'm looking at my immediately, what's the closest proximity discount array? It's this order block. But we're also trading real close to what would be mean threshold of that. So I have to make an allowance for what? There's got to be 3 PD arrays. 3 PD arrays that every single time I'm looking at price as an entry, or if I'm moving my stop loss, I have to have something that's framing it where there's 3 PD arrays that would otherwise be used as an entry. If they're not respecting price, all 3 of them fail, then I'm wrong. That's where I'm placing my stop loss. Every single time I'm moving my stop based on 3 specific PD arrays. So if we're looking at this down close candle here, and on this candle here, I'm watching price. While I'm not using it as an entry because we're in the target, the low end of where I was seeing it as a draw. We can't take a we can't take a pyramid there. We got to be in the mindset of taking partials. So as it's digging in to this blue shaded area, I'm measuring how much time it takes to get to the first lower quadrant. We hit it here on the low end of the blue shaded area. We consolidated. We have 1 discount array here. How's that a discount array if we're so far away from your entry? Because this is unrealized up here. The upper part of that shaded area, remember I was talking about this is a implied dealing range. It means it's not there yet. So if I'm buying down here and I think that the market's likely to draw all the way up here, best case scenario, which is the terminus level, the upper quadrant or upper level of that blue shaded area, that's what I anticipate seeing price do. I want to see it traverse from here all the way up to here. And I'm willing to submit to the time that it takes to get there. But is it logical? Is it sound money management and trade management for me to just simply demand that's all I get out of the trade? No, absolutely not. So if there's an element of time that's being a large influencing factor in when price is going to do something, it's important for you to understand where they are. Not trade on the basis of patterns for the pattern's sake. The importance is knowing what the market is drawing towards. Why should it have gone up into this blue shaded area at all today? Because we're extremely oversold and we don't need an indicator to tell us that on the daily chart. It's been pressed down a lot all last week and for a month or so. It's gone down. We outlined quarterly shifts that takes what? Months to develop and deliver. A macro are small little intervals in time. They're always 20 minutes. There's a 20-minute cycle that at specific times of the day, if this macro is going to be employed, and there are times when it won't, that's where I'll get it wrong. Just the separation between these two candlesticks here. This is a volume imbalance. Volume imbalance is the same thing that's shaded here in the blue area. That's on a daily chart. It's a larger range. The higher time frame, the larger the imbalances, or like in this case, the volume imbalance, it's a larger range. The smaller the time frame, the smaller the imbalance. So if we're going to be using a higher time frame, I'm absolutely interested in the quadrants. Anything less than that, I'm only interested in the low, the high, and the consequent encroachment midpoint level. Because this is a daily volume imbalance, I want to know where that first quadrant is and how fast does it reach up in there. It does it real quick and energetically. When it hit it, what did it tell you? Did it close below it? Nope, closed above it. That is a signature. That's a signature. Listen, I'm going to tell you something right now, and I know some of you don't want to believe this. You think it's all hokey bullshit, okay? Some Tom Clancy bullshit, okay? But it's not. It's really real. The algorithm that delivers price, there is a class of trader that is actively among all of us. They're not out here trying to draw attention to themselves. They have created high-frequency trading algorithms to do a lot of what they do. And when these things like this happen, it tells their algorithm, like I have Enigma. Enigma is not what books price. Enigma, it handshakes with the algorithm that delivers price. And what does that mean? My algorithm would see this close above that upper quadrant and say, okay, now I can take a long if it trades down into a discount array. So it's going to have to go back through. Where are we at right now? We're here. So go back down. We have consequent correction of this wick here, opening of this order block, mean threshold. So is it permissible to see price wick through mean threshold here, but not close? Yes. Does it do that? Yes. Does it close below mean threshold? No. Does it close below the volume imbalance here? No. So where's price going to go? Higher. Every other person that is deemed smart money, central bank level, cannibalizing traders, okay, they're out there doing these things, high frequency all day long. They're entering on this because they see this was the qualifier to say, okay, we're going to go higher. Now, if it would have closed below this quadrant level there, they're not going to take that trade. They're not going to be in it. Even if it does go up a little bit higher here, it might go there and then roll right back out of it. That's why these things are important. That's why I'm teaching it to you. Those are the little telltale signs that I call a signature that we're looking for in price. If it's not there, I'm not taking the trade. If it's not there, I'm not holding the trade. If it's not there, I'm not going to reach for another objective to take a partial. Where's the next level in quadrant? It's the consequent encroachment. It reaches energetically right here. Where's the close on it? Above it. What's that telling you? It's going to keep going up. That's logic, folks. That's how it's done. That's real fucking order flow. Upper quadrant. Does it close above it? Oh, hell yeah. So that means it's going to reach for what? The upper end of the inefficiency, that blue shaded area. All right, if you look at this low here, this is just swing projections. So if you're looking at just these 2 points here, this low and this high, if price were to break through that, we can anticipate all of these levels here. Now, I use these levels like this one here is close to that one right there. That's what? It's the first quadrant of that daily volume imbalance. And that's why we see it hit there and it consolidates. Then reaching up into -3 standard deviation, we get 1, 2, 3, 4 times outside of these candlesticks. It's really trying to get to that level. I'm looking for these kind of agreements, these confluences of where certain PD arrays and those levels within a PD array, where there's a collection of them, where they're coming together in a convergence, that's more impactful. The algorithm that causes the high and low of the form, that's predetermined before anything happens in the day, the high and low is already predetermined. It's already predetermined. All right, so, okay, we're looking at the aspects of mohawks, okay? Trading outside the levels, coloring outside the lines, if you will. That's what I refer to as something that's permissible. That means we don't look at it as less than efficient. We don't look at it as less than precision. We don't look at it as noise. We anticipate very specific things to see price draw to. If this inefficiency here that's shaded in blue is on the daily chart, that means that we're going to be now considering its quadrants because it's large enough to be referring to it. Contrast that with this down here, okay? It's so small, it's not essential. There's not much of a difference between between the low, the high, and let me scrunch it back up so you can see. It's the balanced price range over here that's going to act just like an inversion fair value gap. Trades down into what? If it's an inversion fair value gap, we want to see it respect consequent encroachment, which is midpoint. Can it trade to the lower end? Yes, but it's not likely to do that if it's coupled with a balanced price range where price goes up and down. So it's traversed between these two price points of this candle's body and this candle's body and that one. It's offered buy side and sell side. So it's efficiently delivered and booked price between those two price levels. But your stop loss has to be at least considering the fact that it can do this little mohawk thing. It can do that right to that low if it's an inversion fair value gap. So in other words, it can create just one tick or two below that. But it's not likely, highly probable that it won't do that because it's coupled to a balanced price range where price has gone up and down within those very specific price points. That's why consequent encroachment stops it here and stops it here. The bodies confirm while you're watching price because it doesn't close below the consequent encroachment. So if we're anticipating and allowing for a mohawk, something that's just outside the lines of what we're anticipating and seeing as impactful, noteworthy in the trade, in the tape reading, in the price delivery, we're not reducing its level of precision. When it does this, we are already expecting it. That's all that this is right here. This right here on a 1 minute chart, you can see the bodies of the candles here, but if you go up to like a 5 minute chart, that's just going to be a wick. See how it's a wick? So this is a mohawk inside of the daily volume imbalance. The algorithm is going to determine the high and low of the day before we start trading in midnight, New York local time. At that moment, right then and there, the high and low is already predetermined. If we think that it's going to go up to go down, and we can run numbers on the range at midnight, then we run the range again at 8:30, run the range again at 9:30. Where's the highest high and the lowest low? And what does it still have in play for a reach or draw on liquidity? So we see this area here as a small little deviation outside of what we were expecting, which is that blue shaded area. Now with these quadrants out, if we were looking at it from the scope of the bodies, this is where you would have that there. It's calling for 71. You have to come to the conclusion that your exits don't require perfection. Your entries don't even require perfection.